There is a number. It is so large that your brain refuses to process it. It rises every second. Not slowly, not occasionally, relentlessly. It rises when you wake up. It rises while you work. It rises while you sleep. No election stops it. No political party reverses it. No economic cycle eliminates it. National debt. Trillions upon trillions of dollars. And here is the uncomfortable truth. It is not designed to go down. Pause. Let that settle. Because if you believe national debt is a temporary problem that will eventually be fixed, you are misunderstanding how modern money works. Debt is not a malfunction. It is not a budgeting mistake. It is not political incompetence. Debt is the operating system. And once you understand that, you stop asking why it exists. You start asking why it must exist. Welcome to the Money Matrix. We like to imagine money as something solid. Gold, coins, paper bills. But modern money is none of those things. It is credit. It is promise. It is recorded obligation. When a government spends more than it collects in taxes, it issues bonds. Those bonds are purchased by investors, institutions, pension funds, and often by central banks. In the United States, that central institution is the Federal Reserve System. Here is where it becomes psychologically uncomfortable. When the government issues a bond, and the central bank buys it, new money enters the system. No vault was opened. No gold was mined. Numbers were entered into a ledger. Money was created, not from thin air, but from debt. This means something profound. New money requires new debt. If no one borrows, money supply does not expand. If governments stopped issuing debt tomorrow, liquidity would shrink. Modern economies depend on expanding money supply to support growth, population, trade, and investment. Debt is not separate from money. Debt is the source of money. And this is where the illusion begins. Because you believe you earn money, but the system expands money through borrowing. Your salary exists inside a debt-based framework.
In 1694, England was at war and desperately needed financing. A financial proposal led to the creation of the Bank of England. The idea was simple, but revolutionary. The government would borrow large sums. Instead of repaying the principal immediately, it would pay interest. The debt would be rolled over. What changed here was not borrowing itself. Governments had borrowed for centuries. What changed was permanence. Debt was no longer emergency-based. It became structural, a feature of governance. Over time, sovereign bonds became trusted assets. In 19th century Europe, financiers like Nathan Meyer Rothschild helped expand bond markets across borders. Debt became tradable, liquid, interconnected. When one nation borrowed, investors in another nation participated. The world became financially intertwined. This increased stability, but it also increased dependency. Because once financial systems are interconnected, default becomes catastrophic. So, what do governments choose instead of default? Refinance, extend, issue new bonds. The system moves forward, never backward. By the early 20th century, banking panics exposed weaknesses in decentralized systems. In 1913, the Federal Reserve System was established to stabilize liquidity. This allowed for a new era of elastic money. During wars, crises, recessions, the money supply could expand rapidly. World War I, World War II, the Great Depression, massive borrowing financed survival and recovery. Without debt markets, these events would have collapsed governments entirely. Debt enabled modern-scale highways, hospitals, defense systems, space exploration. But expansion has a cost. When borrowing becomes normalized, political incentives change. Voters prefer benefits. Politicians prefer spending. Markets prefer liquidity. No one wins elections by promising austerity. So deficits become routine. Debt compounds. And because the economy also grows, the system appears stable. But here is the philosophical tension. If growth slows, debt becomes heavier. If growth accelerates, debt expands with it. The system does not eliminate debt. It manages it. In 1979, inflation in the United States surged. The chairman of the Federal Reserve, Paul Volcker, raised interest rates dramatically. It worked. Inflation fell, but high interest rates made borrowing more expensive globally. Developing nations that had borrowed in U.S. dollars struggled. Many turned to the International Monetary Fund. The IMF offered assistance with conditions, structural reforms, spending cuts, market liberalization. Supporters argue this improved efficiency. Critics argue it increased dependency. But the deeper truth is this: debt creates leverage. Financial relationships influence policy decisions. Not because of evil masterminds, but because incentives shape behavior. When you owe, you negotiate from weakness. This is true for individuals. It is also true for nations. Inflation is often described as rising prices, but inflation is more accurately declining purchasing power. If money supply expands faster than production, prices adjust. Governments rarely announce inflation as policy, but moderate inflation reduces the real burden of debt over time. If a government owes $1 trillion and inflation reduces the real value of that currency, repayment becomes easier in real terms. Who benefits? Borrowers, asset holders, debtors. Who loses? Savers, fixed-wage earners. Inflation is not dramatic. It is gradual. It operates quietly. It is the slow erosion of stored value. Psychologically, humans adapt. If prices rise 3% per year, no one panics. But over 20 years, purchasing power shifts dramatically. The system survives through subtle adjustments. Zoom in from nations to individuals. Mortgages, car loans, student debt, credit cards. Debt is normalized. In fact, credit scores reward borrowing behavior. You are encouraged to build credit, to demonstrate reliability, to participate. But here is the psychological layer. When your income is pre-committed to future payments, your risk tolerance shrinks. You hesitate to quit your job. You avoid starting a business. You choose security over freedom. Debt disciplines behavior not by force, but by obligation. And because everyone around you participates, it feels natural. The cage does not look like a cage. It looks like adulthood. Imagine tomorrow every country decided to eliminate debt completely. Governments would need to raise taxes massively or slash spending. Bond markets would collapse. Banks holding sovereign debt would destabilize. money supply would contract sharply. Credit would freeze, trade would slow, asset prices would crash. The modern economy is layered on credit. Remove credit abruptly, and liquidity disappears. So the system chooses continuity, roll debt forward, adjust interest rates, manage inflation, sustain growth. Not because collapse is impossible, but because collapse is worse. Debt persists because the alternative is destabilization. The uncomfortable truth is not that four men secretly engineered 300 years of control. The uncomfortable truth is simpler. The system evolved logically. War required financing, industry required capital, globalization required liquidity. Each step made sense. Each solution solved a problem. But collectively, they created permanence, permanent debt, permanent expansion, permanent dependency on growth. And here is where philosophy enters. If growth must continue forever to sustain debt, is infinite growth possible on a finite planet? If inflation must continue to ease debt burdens, is saving ever truly safe? If debt structures behavior, how free are economic actors? These are not conspiracy questions. They are structural questions. Understanding the money matrix does not require rebellion. It requires awareness. You cannot dismantle a 300-year financial evolution alone, but you can navigate it intelligently, reduce high-interest consumer debt, avoid lifestyle inflation, build emergency reserves, invest in productive assets, understand how central banking works, recognize inflation's effect on savings, shift from pure consumption to ownership. The system rewards participants who understand leverage. It burdens participants who ignore it. Debt is not evil, but ignorance is expensive. The money matrix does not collapse easily. It adapts, it recalibrates, it evolves. The real question is not, why is there so much debt? The real question is, will you remain unaware of how it shapes your life? Because once you see the architecture, you cannot unsee it. And once you understand the incentives, you stop being shocked by the number. You understand why it never stops rising. Debt is not a crisis waiting to explode. It is the engine that must keep running. The only choice you have is whether you stand under the weight of it or learn how to position yourself within it. Welcome to the Money Matrix.